I'm Jason with First Coast Mortgage Funding, and I'm here with the wizard. So, on our staff at First Coast Mortgage Funding, we have a guy that has been in the industry for how long, Craig?
1987.
1987. He's seen so much in the industry, and one of the huge things that Craig provides our team is insight into mortgage-backed securities and rates and what things are going to do. So what I thought would be a good little video that we could shoot was what is going to happen in 2024 with mortgage interest rates. So let's just start. What's your overall perspective of what's going on in the market?
Well, 2024 is kind of a unique year. As you know, we're in an election year, so there's that overlay. And then you've got the geopolitical things going on in the Middle East, and that actually affects our market considerably. But just as far as the economy goes in the United States, which is the primary focus of what interest rates do and how they operate, we're really in a deflationary time right now, with the Federal Reserve working very hard to get inflation down to their target 2% level. We've dropped considerably since the highs, but they've still got a little room to work. The majority of the people that monitor the Federal Reserve, they believe they're going to start lowering the federal funds rate, which is the rate that the Fed charges banks. But then that flows into ours just through the attrition of the way money is used and that sort of thing. So it would, as the Fed funds rate drops, you typically see a drop in mortgage rates. We've already seen a beginning of that, even though the Fed hasn't started dropping. What they actually did was they kept them from going up more and signaled that they're going to be planning on doing drops this year. So the market has already started building that into the market itself, and mortgage rates have come down since the highs in October.
Really interesting stuff. So if you were to project it, and let's keep it first quarter, okay? Because we'll do the later projections too. But first quarter, so what do you think is going to happen to rates in first quarter?
Well, right now, if we look at the average mortgage rate nationally, it's about 6.7%. Now, that's very difficult when people look at that number because it's varied. It's got different products, different credit scores, lots of different components. But that's the average that the industry monitors. And I believe that in the next quarter, by the end of the first quarter, we're already halfway through January, I think there's going to be some volatility. I believe that by the end, we're going to start seeing more signals that the economy is going in the direction to warrant the Federal Reserve to do what it's already said it hopes to be able to do this year. So I do believe that you'll see some softening of rates down, but I think it's going to be very measured with some volatility in the mix.
Got it. So I know, in the previous years, we'd go to bed at night, and sometimes in the morning we'd already be shooting up. So you don't think it's going to be like that? You think it's be more subtle?
I think it will be. I think there'll be some volatility. Volatility just means lots of changes or big changes in a small period of time, but usually comes back to where it was. It's just kind of like bouncing. It's like taking a ball and bouncing it in the floor, hits the ceiling, and it bounces back. That's what I refer to as the volatility. And I think that's what we're going to be seeing, because the market is just trying to get grips. Are we really going to start seeing the economy slow down to the point where interest rates are going to come down with it?
Yep, got it. So for the election year, so on the election year, does the government have control, or does anyone have control to really affect interest rates like that? So
well, that's a great question. Technically, yes and no.
Okay.
The Federal Reserve is a government institution, and they control the Fed funds rate, which we've already talked about, but they also will do things like buy mortgage-backed securities or sell mortgage-backed securities, and that can have a significant impact in interest rates, like it did a couple of years ago when rates were so low. They were out there just gobbling up mortgage-backed securities. And that was keeping rates artificially low. It wasn't really the market that was doing it. It was the supply and demand. Somebody came in and started buying everything up, and there was enough to buy, so that caused that to happen.
Got it. So let's fast forward. We have election year coming up and everything like that. Prediction as far as, give me a rate. So you said, we're filming here in mid-January, and we're sitting about 6.7 as an average. So give me a projection, let's say by the end of June.
End of June, I think we're going to be in the low sixes.
Low sixes, okay.
Yes.
We'll take that.
6 to somewhere in that range.
Okay.
Of course, I hate to put an asterisk, but assuming no unexpected changes in the geopolitical format or so forth and so on. But if it continues on the path, that's what I would think would happen.
Okay. And so do you think that there'll be any drops beyond that before the election?
I do.
Okay.
I think that probably prior to the election, we'll start printing a 5. It'll be a high 5, I think, but I think we'll start seeing 5s being kind of the more common thing for a lot of reasons, not just because of the Fed and all the other factors, but I think the election year is going to put pressure on rates to come down if they can have that happen.
Cool. So that's all good news, as we've been used to higher than that. Is there anything in the market, anything in the market that, as it stands right now, that would do the opposite? We go from 6.7 to 7.5. If
the continued monthly economic numbers come out to show that inflation is rearing its ugly head again and it's going back up, the Federal Reserve will quickly put a pause on any future rate cuts and the market will respond quickly. Okay. And even one of the Fed members today even came out and said that they need to be careful and reduce rates on a measured basis based on the information as it comes out.
Okay. So let's tie this to housing, right? So, our market and a lot of markets across the country still have low inventory. So rates, got to 8.5% last year,
right? And
we didn't see values decrease, and we still have low inventory. So, what do you think will happen on the housing side if, let's say we do go to 6? Let's say we go in the 5s, like you said. So we go in the high 5s. What's going to happen to housing?
It's going to be crazy, probably. Okay. It's interesting about that, though, because with the rates dropped from 8% down to where we are now, we've seen a little bit of influx in our market, but nationally it's not been the case. So I think that you have to look at it almost from a regional standpoint. But yeah, I do believe that the interest rates will play a role because of the affordability, because I believe prices will continue to go up. Maybe not as fast, but supply and demand is a big factor.
Got it. So it seems like we in our market at least, we have a lot of people that are still sitting at 3s and 4s right on their current home, and they didn't want to go to, and still don't want to go to 6.5, 7. But as we go down a bit, and I believe the same thing is like we go down into the 5s, then going from 4 to 5.5 or 6% doesn't seem like that much of a jump to have a lifestyle change or new house.
I would agree with that, and I think that will help. That's why I don't think prices are going to go crazy. I think they're going to have some measured, because I do believe more supply will come into the market, because you've got the people that want to move but just haven't because of the interest rates. And as that does come down, it will cause people to rethink their plans.
Yeah. There are some people that think that maybe we're heading towards a crash. What do you think about that?
Well, the market today is a lot different than the market from the 2006, 2008 real estate crash that we all experienced. First off, delinquencies are very low compared to then. Prices are appreciating, but slowly, though, in a more measured pace, maybe not slowly depending on the market, but it's supply and demand driven, meaning back then what was happening was a glut of supply, which caused the huge drop in prices, not to mention the financial things. But the general market now needs more supply because there's more people wanting to buy than there are houses.
Yeah.
So that's preventing it from just going too crazy. And then also, I believe that the other factor is that the mortgage market as an industry has been regulated a little more.
Sure. Yep.
And programs have gone away. Back then, you could breathe on a mirror, and if you made fog, you got a loan. nowadays there are regulations to make sure that borrowers could actually qualify, which is tempering the default rates.
Yeah, so that's one thing that I always think about when talking to clients is, it back then it's, people were in houses that they couldn't afford,
Right.
and we just don't have that now.
Yes.
And the default rates are very low.
They are significantly different than what they were right before the crash. And so I think there's some built-in protections. Now, that being said, I suppose it could happen in the right environment with certain things going on in the marketplace. For instance, if we actually didn't do a soft landing, which is the gold that the Fed always wants to find, and if they go too far and we go into a recession. But the economy doesn't, the employment numbers don't prove that out. The people are working, they're getting jobs and that sort of thing. So I don't feel like that's probably a likely outcome.
Yeah. So, Craig, you're a wealth of knowledge.
Thank
we
you.
appreciate having you on the team. And, one thing that I know is really important to our loan officers is, we've got our own built-in mortgage-backed security guy. So, each morning, and if anything happens in the market, our loan officers get an email from you. Here's what's going on. Because a lot of times it's data that the average person, not like you, understands. So, a lot of times you'll say, hey, we should do this today. We should do that today. We should be, afloat today. We should be a lock. Hey, watch this, watch that. So that's a huge advantage, at First Coast that our loan officers have. Because, we've got different services and stuff like that, but it's very hard to decipher some of that.
There's a lot of data out there.
Yeah. So we appreciate that. And thanks for all you do.
Love doing it.
All right.